It's very interesting to me that we've had no growth in business capital spending over the past year. We had tremendous growth in industrial construction, but classic machinery and equipment spending is basically flat on a year-over-year basis. What is going on here? People have it in their mind that we have this great economy going on. It's been government, okay, and it's been the consumer that's been aided and abetted by the government and this drawdown in the savings rate. And of course, the consumer is 70% of GDP. But where's CapEx? And you look at the monthly numbers from the Commerce Department on core capital goods orders and shipments, there is nothing going on. There's nothing going on. And despite all this excitement over AI, well, AI is not the entire economy. There's no growth in capital spending. Why? Well, what's happening is that the C-suite of corporate America, they're seeing the debt rollover calendar, their incremental debt servicing costs that are going to cut into their earnings. That's why employment is slowing down, and we'll talk about why the numbers are actually worse than they appear at the headline level. But companies right now are being forced to retain their earnings to service their future debt servicing out of their cash flows. That money is not going to go into new hiring. That money is not going to be going into new CapEx. It's going to be going into debt service, and the corporate sector is preparing for it. And that comes out of GDP. And then there's all sorts of multiplier impacts and leakages from cutbacks at the corporate level, small business and large business, to the rest of the economy. So to say, well, no recession in 2023, therefore there's no recession in 2024 is like me saying back in December in Toronto, well, it didn't snow, so winter's been called off. And think about what a crazy comment that is. Look, people were saying the same thing back in 2000. Where's this recession? Where's this recession? Well, the lags kicked in, guess what? With perfect hindsight in March of 2001. All in 2007, I'm at Mother Merrill. I was shunned. I was ignored and shunned, and it's as if I had leprosy. And the sales force stopped marketing. It's a miracle that I got ranked in II that year. 07, I was just too bearish, and what do you know? Wrong on the recession call. And what happened in 08 was my calendar was jammed. I was working 24/7. And clients were saying at the meetings I was at to the salespeople, how come you didn't take Rosie around to see me last year? Well, I'll tell you why. Because everybody believed no recession in 07. Well, why would we expect one in 08? No recession in 2023. Why would we expect in 2024? So, yeah, I think that, the lags can be long when you get stuff jammed up along the way. In 07, there was still gargantuan housing-related stimulus that kept the Energizer Bunny going right through the end of the year. But nobody at that point thought a recession was coming in 08. And so when did the Fed stop tightening? That cycle was in basically the summer of 06. And the recession didn't start till the end of 07. So the Fed this time, the last rate hike was July of last year. And here we are in May, almost a year after. Yes, sometimes the lags are quick. Sometimes the lags take longer. But for people to say to me that the U.S. economy, a credit-driven economy, is no longer interest-sensitive, and that the business cycle has somehow been repealed, what can I say? I stopped believing in fairy tales. Every cycle is different. Every cycle has its peculiarities and its unique characteristics, and there's similarities, but they all end at the hands of the Fed, and only when the Fed tightens into an inverted yield curve. The only times in the past where we lucked into a perpetual soft landing, which was in the mid-1960s, the mid-80s, and the mid-90s, the Fed stopped. The Fed stopped before the yield curve inverted, but not this version of the Fed. And it's a different Fed, and they got burnt badly by transitory. They continue to feel as though their credibility is somehow and their integrity somehow is at stake. Nobody wants to be compared to Arthur Burns, that's for sure, especially a chairman heading into his last term. So they're deliberately hawkish. I guess we could argue that the last meeting, Powell wasn't that hawkish. I guess saying that we're not going to hike rates, I guess that classifies as being dovish these days. I was getting clients all the time asking me, will they hike rates? Will they hike rates? I knew for a fact that he was going to be asked, and he was just asked repeatedly about whether they're going to hike rates. I mean, the media in the room, they're like a dog with a bone. They must ask them 5 times. They hike. Somebody says, was a rate hike on the table? Was it discussed? Couldn't get, they're not hiking rates. Question is when are they going to take out the restraint, which is what he said. And the reality is that he's not confident as to when they're going to do it. I never seen a Federal Reserve so so anally retentive on coincidental lagging indicators. He's telling us what they're looking at. They're looking at the unemployment rate. They're looking at job openings, relative to unemployment. They're looking at the inflation rate. None of those are all lagging indicators. A central bank that focuses policy on lagging and contemporaneous coincident indicators is a central bank that's going to be destined to making a policy mistake. They were behind the inflation curve, and now they're behind the growth curve. And they were behind the inflation curve, and then, who knew the extent to which? And then next thing you know, we have an 18-month, wasn't 18 quarters or 18 years, it wasn't the 1970s, but they got ahead of it, but they were slow. And now they're slow in the other direction. They are like a deer in the headlights. And so I think that the longer they keep rates at this level, and inflation is coming down, the trend is coming down, it means real rates are going up. And the level of confidence they have to have after everything that's happened. And maybe what I have to do is put myself in their shoes. But after everything that happened, when they cut rates, they want to be as close to 100% sure that it's the right timing. Now, nothing's 100%. And the Fed they're like everybody else on this call. They're managing risk. But the risk now for the rest of us is that they're going to wait too long. And it's not the first time. This is not monetary policy run by robots. Not yet. And as brilliant as they are, they're prone to mistakes. And I think actually if they had the choice between a recession and inflation, they choose the recession. And the one thing they're not going to tolerate is inflation. So they're going to cut rates. I think they're going to cut them hard. I thought at some point it would be a 2024 story, but they're telling us. And then the election will get in the way. Powell says we're not political, and they're not really political, but I think they'd rather stay silent, especially around this particular election. So probably more of a 2025 story where rates really come down and come down hard. But yeah, I think that there's serious risks. So he addressed them. He addressed the risks of waiting too long, but it's a risk, and they know all this stuff. It's a risk they're willing to take on. We got something called the QCEW a few weeks ago. Acronym for what? Quarterly Census of Employment and Wages. It's everything. This is census data, and because it includes everything, including the kitchen sink, it's lagged, so it goes to the third quarter of last year. It includes 12 million entities. To repeat, it's the census, it's everything. Non-farm payroll that the Fed bows to the holy grail of non-farm payrolls is 700,000 establishments. The QCW is 12 million. It's not a sample. It's not a sample, okay? Plus the response rate post-COVID in all these surveys, including non-farm, is down around 40%. It's rarely, if ever, been this low. So what the QCEW showed is that on a year-over-year basis, non-farm payrolls are being overstated by between 800,000 and 1 million.
Wow.
In other words, you got to shave the headline numbers by 70 to 80,000. And so why is that? Why is that? Because of the birth-death model. And I'm not talking about obstetricians here. I'm talking about that the BLS has a fudge factor called birth-death. It is a separate model that they've created, very sophisticated, and then they add on that number to the actual survey. Nobody talks about this. So they try and estimate through their birth-death model employment that they don't feel they're capturing by the existing non-farm survey by trying to estimate every month the net creation of business and what that's doing to employment. Now, I don't know what's going on at the BLS because I'm looking at the data. I have up-to-date data, and I could see that business insolvencies are up 35% over the past year. Now, I don't know. That sounds like a bit of a recessionary statistic, although It's not showing up in a lot of the other data, admittedly. It's not a consumer spending data, right? It has nothing to do with the savings rate. Corporate insolvencies up 35%, and the gross business formation is down 5% over the past year. And what do you know? We get Friday's number, and as puny as the 175,000 number was, benchmarked against 240,000 consensus estimate, half of the growth in payrolls on Friday came from that birth-death model. Like basically you're talking more like 80 to 90,000 actually came from the survey. And so when you look at the data, you can see what's going on. They are massively inflated. And now we have the evidence from the QCEW. Not just that, but the QCEW also provides wage data. And between the wage data and the employment data in the census, this is not an estimate, that the current government data on income is overstating income by $650 billion. $650 billion. of income overstatement, 800,000 to 1 million jobs. So look, I'm not a conspiracy theorist. I'm just talking about the fact that nobody is playing around with the numbers. It's just that these numbers, which are always flawed, they're based on surveys and they're based on sample sizes. What I'm saying is that the error term around all the data that people are trading around in their personal accounts, because who's not a day trader these days, and the data that the Fed is formulating policy decisions around have a much wider error term around them than they ever have in the past. That's where, once again, you get to a classic policy misstep, where this will basically be a major Homer Simpson dough. That's what it's going to be. So we actually have the bird in the hand. We know $650 billion. That's not chump change. That's 3% of income is being overstated. Do you know that if the QCW is right, and why wouldn't it be? It is the census data. It is the complete database. Do you know that the savings rate is not 3%? It's 1%. So to propel, like when we're looking at catalysts for what's going to drive the economy going forward, what's the bullish case? That the savings rate is actually going to swing negative? We're going to desave? So, but the major point is, and this is my big concern, is that the Fed is focused too much on data that has a very wide error term. And I think that, they were scrambling to raise rates. They'll be scrambling to cut rates. It'll be in a totally different market and macro circumstance than we have right now. But I am a little concerned that the Fed is focused so much. And I'll tell you, I didn't have this concern back in December, because in December, I felt liberated because Patrick Harker, who heads up the Philly Fed, gave a speech where he said that we are no longer going to be focused exclusively on the incoming government data. We are going to pay attention at least as much to survey data and to what our business contacts are telling us. And I said, well, that's exactly right. That's when the market started pricing in 6 rate cuts, because they all knew what the vast majority, I guess they front run a lot of the retailers, including Starbucks, right? Like they sort of knew. And then what do you know that in the December meeting, what does Powell talk about? The Beige Book, the venerable 53-year-old Fed Beige Book. I've never seen a Fed chairman spend as much time talking about the Beige Book as Powell did in December. So of course, the market front run the Fed. Will go from 3 cuts to 6. He's talking about the Beige Book. And of course, anybody who read the Beige Book in December was going, whoa, daddy, wow. It was really weak. And the Beige Book is the richest piece of information, all anecdotal, but it's all what business contacts are telling the Fed. It goes back 53 years. To show you what a fun-loving guy I am, this is how I spend my time on the tarmac. I read Beige Books, but it is a wealth of information by region and by industry, right up to date on what's happening in the U.S. economy that is not in the data. So I'll just say that nobody talks about that anymore. Did Powell mention the Beige Book at the last meeting? No. Or the meeting before that? No. And they've all sounded very hawkish. Even Goolsbee, who was the last holdout on the Dover side, they're back to focus their data dependency at a time when the data have such a wide error term should be troubling for everybody. But the Fed told us in December we are going to listen to our business contacts. And the reason they said that is they said we should have listened to them before the inflation bulge, because they warned us. Right. And it wasn't in the data. So you read the last Beige Book that came out a few weeks ago. You can't read that Beige Book and come to the conclusion that this is a 3% growth economy. Not a snowball's chance in hell. Now, was it recessionary? No. But let's say that you read the Beige Book and it came right out with information right up to April. Pretty flat economy. Pretty flat. Pretty European-like. Except Europe's coming at it from a situation where nobody expected anything but negative, and flat is good. The US, it's like perpetual 3% growth, and the United States has miraculously destroyed Mother Nature. There's no such thing as a recession anymore. But you read the Beige Book and flat economy. And for all the anxiety and angst over inflation, you could not read the Beige Book and find any inflation. I know people like to talk about inflation because what they do is they conflate. They're talking on CNBC today about egg prices. Okay, inflation is not prices, it's the change in prices. Paul Volcker, who is bigger than Paul Volcker, not just literally but figuratively, the world's most acute inflation dragon slayer. But the price level under his 7-year tenure at the Fed went up 60%. Prices never went down. So people conflate prices and rate of change. And the Beige Book was replete with evidence from business contacts they have no pricing power. Their pricing power that they had last year and 2 years ago has completely diminished. And all we have is a central bank that focuses on what? The CPI? The CPI? Really? The CPI, where 27% of the index is one question, owner's equivalent rent. People know that 27% of the CPI that you trade around, I don't trade around these numbers. It's one question. It's not even, OER is not even a price anybody pays. 27% of the index, not gas, not food, not healthcare. It's OER. And it's one question to the sample of homeowners on the survey. What do you think you'll be able to rent your house out for in the coming year? That's what the Fed is basing its rates decisions on.